While the retail market focused on daily price swings, institutional capital quietly triggered a massive regime shift. The semiconductor index, the absolute vanguard of the artificial intelligence trade, has officially slipped into a bear market, tumbling more than 20% from its summer peak. This is not just a standard technical correction. It is a fundamental repricing of the entire AI growth thesis, driven by escalating concerns over massive corporate capital expenditures and fresh competitive threats from Chinese software players. The market is starting to ask a brutal question: is the return on investment for this massive computing infrastructure actually real? To understand where the capital is flowing, we must first look at the core structural moat of this entire ecosystem. The hardware stack is controlled by a tiny handful of companies that manage the physical design and fabrication of high-performance computing. NVIDIA dominates GPU architecture, while Taiwan Semiconductor Manufacturing Company serves as the sole fabrication foundation for high-end chips. ASML controls the extreme ultraviolet lithography systems required to print these complex patterns. This physical bottleneck has created an unprecedented economic moat, allowing these firms to command near-monopoly pricing power over the global technology supply chain. But that is only part of the story. This physical hardware moat is entirely dependent on a massive capital loop funded by a very small group of end users. These are the cloud hyperscalers, led by Microsoft and Alphabet. These companies have spent the last 2 years engaging in an aggressive arms race, building out massive data centers to host foundational models. Their capital expenditures represent the direct revenue engine for the hardware designers. If the hyperscalers decide to slow down their cloud buildouts, the entire business model for the chip designers instantly faces a massive structural demand cliff. Here's where the financial metrics become interesting. The latest quarterly reports from Microsoft and Alphabet revealed a staggering trend in capital expenditures. Together, the big cloud providers spent tens of billions of dollars on hardware in a single quarter. Yet, when analysts looked at the corresponding revenue expansion from generative AI software, the figures were remarkably modest. We are seeing a classic structural divergence. The capital outlay is growing exponentially, while the near-term monetization of software services is growing linearly. This dynamic has institutional managers asking if the depreciation costs of these hardware assets will permanently depress cloud operating margins. Now look at how the broader sector is reacting to these numbers. While NVIDIA managed to show impressive headline revenue, their forward gross margins actually showed early signs of stabilization rather than continued expansion. Meanwhile, competitors like AMD are spending heavily on research and development to catch up, resulting in near-term operating margin pressure. The chip index's 20% drop is a reflection of this reality. The market is no longer willing to value these companies based on infinite growth projections. Instead, institutional capital is repricing them based on traditional cash flow models and cyclical supply risks. The next signal comes from management's capital allocation strategy. During the latest conference calls, the chief executives of the major hyperscalers went on the defensive. They argued that the risk of underinvesting in AI infrastructure far outweighs the risk of overinvesting. They claim that building these data centers now is critical to securing long-term market share, even if the applications are not fully monetized today. While this narrative keeps hardware orders high in the short term, it also suggests that these firms are investing out of fear rather than clear demand visibility. This represents a classic capital intensity risk. From the chip design perspective, management commentary is shifting focus toward operational execution. NVIDIA's leadership has been working to address engineering challenges with their next-generation Blackwell architecture, aiming to reassure the street that production remains on track. At the same time, AMD is aggressively rolling out their MI300 series to capture value in the enterprise market. The core message from the hardware makers is that demand remains robust. However, when you look closely at their statements, they are increasingly relying on the continued capital spending of just 5 or 6 major corporate buyers. That leads us to a bigger question regarding macro-systemic risks. This sector drawdown is not happening in a vacuum. The global macroeconomic environment has shifted significantly. We are seeing a structural normalization of interest rates, which alters the cost of capital for long-duration growth assets. When capital was virtually free, Investors were willing to pay high multiples for projected earnings decades in the future. In today's higher-yield environment, institutional capital demands immediate, tangible free cash flows. This macro regime change is putting intense pressure on high-multiple technology assets. But the absolute catalyst for the recent sell-off came from an unexpected direction. China's Moonshot AI recently released a highly advanced, low-cost model that has sent shockwaves through the tech sector. This developer showed that powerful software models can be trained and run far more efficiently than previously thought. This development directly threatens the high pricing power of Western software companies and reduces the total amount of GPU computing power needed to achieve cutting-edge performance. It is a stark reminder that software innovation can quickly disrupt hardware demand. Something important is happening here in terms of fundamental structural risk. The industry is currently facing a looming risk of overcapacity. During cyclical upswings, every player in the supply chain double orders components to avoid shortages. Fabricators build new factories, and designers secure as much capacity as possible. But when the end market demand begins to soften, the entire pipeline experiences a sudden, severe inventory correction. If corporate enterprise clients do not adopt these software solutions at scale over the next year, hyperscalers will quickly cut back on their hardware procurement, triggering a massive supply glut. This risk of overcapacity is further complicated by severe geopolitical headwinds. ASML and TSMC are operating at the center of a complex trade conflict between Washington and Beijing. Modern export restrictions are limiting the ability of advanced chip manufacturers to sell high-end computing products to Chinese enterprise clients. This effectively cuts off a significant source of historical revenue growth. Furthermore, any escalation of regional tensions around the Taiwan Strait represents a systemic tail risk that could instantly disrupt 90% of the global advanced semiconductor supply chain. This brings us to a critical forward-looking valuation reassessment. When we look at current multiples, many of the leading chip designers are trading at valuations that assume perfect operational execution and infinite margin expansion. That is why we are issuing a trim consideration on those names displaying extreme historical extensions above their moving averages. The easy money in the hardware trade has been made. To justify their current multiples, these businesses must prove that their technology is creating genuine productivity gains for the real economy, not just other technology companies. That is where things get interesting for the next stage of this cycle. The next major catalyst will likely not come from the hardware layers, but from the software application layer. We are placing high-quality enterprise software platforms on a breakout watch. These are the companies that can take this raw computing infrastructure and transform it into highly efficient, high-margin consumer products. The hardware layer is currently experiencing the classic capital-intensive infrastructure build phase. Once that build phase concludes, the value will rapidly migrate to the companies that own the actual customer relationship. As an institutional investor, how do you position your capital in this changing environment? The tactical playbook requires immediate focus on asset insulation and capital rotation. We are shifting capital away from speculative hardware names with high beta and moving toward high-conviction, cash-generative firms with low capital intensity. This means identifying companies with defensive business models, strong balance sheets, and pricing power that do not rely on constant capital injections. Protecting capital during a major sector transition is always the key to long-term compounding success. The artificial intelligence trade is not dying, but it is maturing. The transition from speculative hype to fundamental economic reality is always a painful, volatile process for growth investors. To navigate these complex global structural trends and protect your capital, you need institutional-grade analysis on a daily basis. Subscribe to SR Money News and join our private desk as we track these massive liquidity shifts. Let us know in the comments below, are you trimming your semiconductor holdings, or are you preparing to buy this dip? We will see you in the next analysis.